Hi there, welcome to Smart Stock Investor. My name is Remco and I am investing my private money in the stock markets. A lot of people fear that when they invest their money in the stock markets that they're going to lose money. And yes, that risk is there. Markets actually move. Stock prices go up, they go down, and you simply don't know if you're going to buy the right stock at the right time and if it has a better value next month. But it doesn't matter. I'm going to explain you why you should still invest in stocks despite the risks of stocks going down. It's very important to know that when you invest in stocks, you shouldn't just pick 1, 2, or 3 shares. Your portfolio that you build up should actually become at least 20, but if not, it might be even better, 50 different holdings, 50 different stocks. If you spread your risk, you really minimize the effects of bad picks. If I look at my portfolio, I have about 100 shares in my portfolio, and over the last year, there's about 3 of those shares that actually lost half of their value. Wow, that sounds really bad, right? Well, it isn't, I don't really care because it just happens. If you buy 100 shares, there will be some rotten apples. So it is more important to focus on the shares in my portfolio that did well. Now, if I look at the best performing stocks, there's 3 stocks that actually tripled in value. Wow, that is even better. Now imagine I invested 1,000 in each of these 6 stocks, the 3 losers and the 3 winners, and calculate what I have now. I invested 3,000 in the losers, that is worth 1,500 now, and I invested 3,000 in the winners, which is worth 9,000 now. So basically, my 6,000 turned into 10,500, which in the end is a real nice return. Now here we come to a very important point. I would like to stress that if you buy shares and they do well, there's no reason to sell them if they are up, because if you sell them, you will miss out on the real great stocks, and you will be left in your portfolio with all the losers because they went down and you don't feel like selling them. So basically, the saying that we use in the stock market is, let your profits run. What you do with your losses, well, I don't really care. If you look at my portfolio now, these 3 well-performing stocks are worth 9,000, and they actually are something like 8% of my portfolio. And the losers, they're only 1.5% of my portfolio. So I have way more invested in the winners after a year than in the losers. This is something that most people don't understand that start investing. They buy a stock, and when it goes up, they sell it. And they think, gee, I made a nice profit. But you should not buy stocks with that attitude. If you buy stocks with the attitude, I'm never going to sell them, then you take different criteria for selecting your stocks. You will actually think, do I really believe in this company? Do I really think that this company will be there 10 years from now, 20 years from now? And if you do so, you tend to make different decisions than if you just think, oh, this stock went down, now I'm going to buy it. It is very important to realize that if you let your profits run, you will actually end up with a few winners in your portfolio that really compensate for all the losses you have. Of those 100 shares that I bought, 25 are still at a little loss. Some are at a big loss, 3 of them. But that means there are 75 at a profit. And from when I started to now, the market has not gone up. We're in the middle of the corona crisis, so all the profits of the market were given in since I started building up my portfolio. But my return is still at 22%. Wow, you might say, 22%, is that much? Well, if you are pretty well invested with like a few $100,000, that's a decent amount you can live off. And also, you should realize if you manage to make more than 10% every year, you get the interest on your interest every year. Basically, this means if your portfolio now is worth 10,000, it will be 11,000 next year, and in the year after 12,100. Now, if you do the math and you multiply 10% over the next 40 years, you will see that you get tremendous amounts, especially when you add money to your portfolio as soon as you can basically add it. You earn some money invested in shares. And if you don't spread your risk, the risk is that you, after a year, will basically have selected those 3 bad stocks that I also selected, and that your money is only half. And the result will be you will probably stop investing. You will wait and you will just not invest in other stocks. So focus on quality shares. There are shares like Unilever or let's say Facebook or Google, Amazon, that have a tremendous track record for 10 years, 20 years, 30 years. The further you look back, you will see that Unilever just went up and up and up. Yes, and it went down every now and then, but in the long run, it went up. If you consider the macro factors, you will see the world is still growing. There's more people every day. There's actually more people living right now than have ever lived before. And there's still plenty of growth chances in markets like China and India and Indonesia, where hundreds of millions or even billions of people live and that don't have much money to spend yet. So for the next 30 or 40 years, it is safe to say that still a lot of stocks have tremendous potential to grow. Okay, this is for now my explanation of why you actually should spread your risk over more companies and why you should be patient. I will post a small video on making interest on interest so you can get a little bit of a picture that how much you can end up with in 30 or 40 years. It's especially important when you're 20 to get started, because it gives you more time to build up your wealth. And who doesn't want to live like I do? You know, I'm sitting here in my house in Cyprus. It's 23 degrees in the beginning of March, and I enjoy the beautiful view, and I look at my investments, and yeah, basically that's why I invest. Thank you for watching, and subscribe if you want to learn everything there is to know about stocks. Bye.